Welcome to We Build Great Apartment Communities, the only show dedicated to the process and strategies for transforming apartment buildings to thriving communities. I am your host, John Brackett, and welcome to the show. All right, folks, welcome to another great episode of We Build Great Apartment Communities, the only place where you can come to learn how to take apartment buildings and turn them into amazing communities. So today we have a very timely discussion and one that I'm very excited about. And I know our audience will be as well, especially with all of our operators on the show and also passive investors, because this is a benefit that passes through. And so today's conversation is going to be about tax strategy. Now, in many cases, okay, when you mention the word tax strategy, many entrepreneurs get very bored of that topic. In the world of real estate, when you mention tax strategy, owner-operators, they pop up, right? It's like their ears perk up. Everybody jumps up. They jump back towards the conversation. So today, I'm really excited to get into a conversation with Tom Castelli. And Tom works for a company called the Real Estate CPA. I'm sure many of you have heard. So Tom Castelli is a tax strategist and real estate investor who helps other real estate investors keep more of their hard-earned dollars in their pockets and out of the government's. I like the summary, man. You guys are good marketers. There's no doubt about that. So now let's get into the conversation of keeping more money in our pockets, Tom. So you and I talked really briefly before we got on this call about some of the cool things that are going on this year that owner-operators should really be aware of, especially as we come into the tax planning year of 2020. And I can tell you, 2020, man, we are so far ahead at this point. I can't say so far ahead. That would be not very accurate, but we're ahead of the curve as it relates to planning, right? So when we get into December, man, I think we have a pretty strong idea of what a lot of these conversations are going to look like to help mitigate against our tax liability, right? So let's talk a little bit about that. First of all, man, please share your background. How in the world did you get into tax planning? I know you're a CPA, but talk to us a little bit about your background and how you kind of transitioned into the area that you are now, but also the fact that you're a real estate investor yourself, which I think makes a really big difference. So share a little bit about that. I think it'll be a really good conversation to share with our audience.
All right. Well, I'll start with the easy part. So basically, I went to college to become an accountant. So that's how I ultimately became a CPA. I ended up working for a firm called BDO, which is a national accounting firm, in the assurance department, which is basically auditing. And what I came to the conclusion is that I'm not this big corporate guy. I like more the small business aspect of it. So that's kind of how I ended up leaving the assurance world and went into tax planning for real estate investors. Now, at the same time, while I was getting started as a CPA, I also read the Rich Dad Poor Dad books in college. I'm sure many people have read the Rich Dad Poor Dad books. And I stumbled onto real estate as being a way to build long-time wealth and not, be part of the 9-to-5 grind per se. And what happened from there is right about 2014, my great uncle had passed away and he had a pretty sizable piece of land and a very small house that was his primary residence. And I knew that the area that it was in a town called Bethpage on Long Island, which was literally a 2-minute walk, probably less, to the train station that took you directly into Manhattan. So into New York City.
Valuable piece of dirt, huh?
It definitely was. And then right around the block, literally like another 2-minute walk away was a shopping center. You had grocery store, pizzeria, laundromat. Then around the block from that, so I'm talking about literally a 2 to 5 minute walk, you're in a village. There's a library, is a village. So
interesting.
I knew it was prime real estate. I was like, oh, this is prime. So what I did was...
I like how you said that. You're like, oh, this is prime. You didn't need to add anything else to it, right? This is prime.
Yeah, there's something here. And so what I did was I went to a Long Island Real Estate Investment Association. And I wanted to try to find a mentor to help me either develop the property or wholesale the property. But long story short, for many reasons, I was never able to get my hands on that property, mainly because of state problems and who was fighting over what within the estate. At that same meeting, though, that same meeting was actually a game changer because what happened was I met a group of people doing a syndication 3-day weekends. And I was like, you know what? This is right before I started my full-time job. I'm like, I'm just going to go to the syndication weekend. So I went to the 3-day weekend and fell in love with real estate syndication. I was like, this is the best business opportunity I could find. You could raise capital, you could be a capitalist, you're talking about investing. It was just the whole nine for me. So I started going to their meetings.
Man, when you said capitalist, your eyes like lit up, man.
Hey, no, dude. I really do love the business aspect of things and the entire like private equity world and stuff. So I was like, this is the real deal. So from there, I started going to their, like, they had like weekly meetings or monthly meetings rather. And I met a guy who would eventually become my mentor. And I invested with him as a limited partner in a few deals, a few multifamily deals. The first one was 48 units in Columbus, Ohio back in 2015. That was a pretty good deal. Did a few more as a limited partner, got a little bit of a behind the scenes look. And then in 2017, I had ended up doing a lot of phone calls and a lot of cold calls rather, and linked up with a broker in Jacksonville, Florida, who sent me an 82 unit apartment complex off market, brought it to my mentor. And I was like, hey, I was like, I think there's something here. And we ended up putting the deal in a contract, flew down there, did the due diligence, we ended up raising capital from a crowdfunding site for that particular deal.
How many units was that?
82 units.
82 units. Okay.
Yeah, I mean, I was taught from that syndication weekend, pretty much go big or go home was pretty much.
Right. Hey, nothing wrong with that.
So that's how I got kind of the mentality I started off with. And then we just sold that property actually in May of 2020 during COVID. Kind of some hurdles to get that deal to the finish line. Had to renegotiate the deal a handful of times and extend it out. And as a result of, like, we were supposed to close on it March 15th, I'm pretty sure was the exact date. But COVID happened and then the buyer exercised their extension, and the next thing you know, we're out in May. But we ended up closing that deal and it was a pretty solid deal. And that's right now, I'm pretty much, honestly, I'm going to be honest, I really don't know where we are in the market right now. So I've kind of been sitting on the sidelines, although I don't know if that's the best idea, but that's what I've been doing.
Awesome, man. Well, let's pivot into tax. I'm sure you're able to, to implement a lot of the tax strategies that we're going to talk about today in your own, investments. So this is going to be kind of a unique conversation. So let's start with some of the changes that you see taking shape right now or that have already taken shape. And so for our operators out there, our investors out there, what would you like to talk about that you feel will create a good value to our owner-operator listeners out there in the marketplace right now?
Absolutely. For owner-operators, there's a lot, but I think the biggest thing is the real estate professional status. And if you're an owner-operator out there, you work full-time in the real property trader business, you self-manage your properties, or you don't have a full-time job, chances are you're qualifying as what's known as a real estate professional. And what that does is it allows you to take the losses from your real estate against your non-passive income. So maybe you have a spouse as a W-2, maybe you run another business, maybe you just have active income from consulting, something along that lines. You could take those losses and use it to mitigate taxes on your other income. And the way you do that is through basically bonus depreciation. So 2017 Tax Cuts and Jobs Act not introduced, but extended pretty much or renewed 100% bonus depreciation until 2022. And now when you buy a rental property, you're going to have different components of the property. You're going to have tangible personal property, also known as 5-year properties, things like certain types of flooring, cabinets, appliances. And then you're going to have land improvements, which is known as 15-year property, things like landscaping, for example, sidewalks, driveways, things of that nature, some underground plumbing systems in some cases. And when you purchase the property, about somewhere between 15 to 25%, sometimes even 30% of the purchase price can be reallocated into this 5, 7, and 15-year property. If you run what's known as a cost segregation study, you'll be able to get those breakdowns. And basically, you'll be able to take the depreciation on that 5 and 15-year property all in the first year. So just give a quick example. Let's say you buy $1 million property. And let's just say on the low end, so it's the very low end, 15% can be reallocated to 5, 7, which is unclassified. But anyway, 5 and 15-year property. And basically, if 15% of $1 million, you're getting a deduction of $150,000 all in the first year.
So you can expense that essentially.
Essentially, yes. Basically, assuming your income was zero, you just have a negative $150,000 deduction. Pretty much you're going to take.
Sure.
And as a real estate professional, first off, you're not paying any tax on your rental income because depreciation wiped that out. So whatever income you had, the depreciation is going to wipe that out in most cases. And then you're going to have a net loss on a net rental loss. As a real estate professional, you could take that net rental loss and have it deducted against your non-passive income. So maybe W-2 income. So for example, if you made $200,000 or say you made $200,000 in W-2 income, but either you or your spouse was able to qualify as a real estate professional, and you take that $150 deduction, you're now only paying taxes on $50,000 of your income.
Yeah, that's huge. That's really, really huge. It's just real estate just has so many advantages, right? Especially when it comes to taxes. It's just absolutely incredible to me. So let's talk a little bit about this. Okay. Let's kind of unpack this a little bit because I think this is a really big deal. So talk a little bit about some of the qualification criteria to be able to get classified as a real estate professional.
Absolutely. So to qualify as a real estate professional, you need to spend at least 750 hours in a real property trade or business and more than half of your total working time. So, for example, if all you do is real estate, then all you need to do is hit 750 hours and you'll be classified as a real estate professional. But if you have a part-time job or you run another business, then you have to make sure that you're spending at least more than half your total working time in real estate to be considered a real estate professional. So, for example, if you worked 1,000 hours in another business, you need to work at least 1,001 hours in a real property trader business to be considered a real estate professional. Real property trader business, real quick, there's about 7 different categories, but rental properties, property management, fixing and flipping, construction, development, brokerage. So you could be an agent, you could be a broker. All those businesses count as real property traders or businesses.
Okay, great. So just to be able to add some context to this conversation, in a traditional working year, we have roughly around 2,080 hours, right? Roughly about 2,080 hours, right? If you're working typically a 40-hour work week.
Correct.
Okay, at a W-2 job. All right. So what you're saying is, John, you roughly need, and to our audience out there, you roughly need to be working or spending at least 750 hours inside of this business, inside of a real estate business to be able to get classified as a real estate professional. Or if you're working somewhere part-time for that matter, then it would have to be roughly 1,000 hours.
The classification is 750 hours and more than half your total working time. So it's a minimum of 750.
Okay, got it. All right. If just to add context to this, right? So if a traditional working year, we're spending roughly around 2,080 hours, okay, which is roughly a 40-hour work week, then our audience should be able to take that benchmark and then measure up against that.
Yeah, exactly. If you're working 2,080 hours, you need to work 2,081 hours in real estate to qualify as a real estate professional.
I like it, man. I like it. I appreciate you clarifying that. Okay, let's get into the CARES Act a little bit.
Yep.
There's a lot going on right now as a result of the CARES Act. So can you highlight, right, some of the key benefits that operators right now should really be aware of, entrepreneurs for that matter? Can you talk a little bit about that, Tom?
Yeah, I mean, I'd say the most powerful one by far, in my opinion at least, to be the net operating loss. And the net operating loss. So before the Tax Cuts and Jobs Act of 2017, if you had a net operating loss, also known as an NOL, you'd be able to carry that back. So for example, let me just explain what a net operating loss is. So let's say that you have a total loss on all your income of negative $100,000. And so that means you're paying no taxes this year at all. You have a true net loss. That's a net operating loss. And in the past, before the Tax Cuts and Jobs Act, that was able to be carried back up to 5 years. So you could take that back 5 years and use that $100,000 to offset income you had paid taxes on in prior years. With the Tax Cuts and Jobs Act, they eliminated that. Now you can only carry it forward under the Tax Cuts and Jobs Act. But then the CARES Act that came out this year in 2020 temporarily suspended the inability to carry it back. So now you can carry it back. I think it's in 2017, 18, 19, and 20, you can actually go back now and carry back that loss up to 5 years. So,
okay, just to be clear, okay, so that our audience can understand this. So essentially now you can take, as of 2020, right, if you have a loss, you can carry that back up to 5 years to offset potentially income that you've had up to 5 years back, right?
Correct.
Okay, so let's use a number. Okay? Say that loss is $100,000. Okay, and 5 years from today, you had a $200,000 gain. that you actually paid tax on, whether it was passed through or not, let's just use a hypothetical, okay, that you actually paid tax on a $200,000 profit, not a gain, but a profit, okay? So that $100,000 you carry back now 5 years, it offsets the $200,000 profit. Okay, so in theory, now you should be getting a refund back of not necessarily 100,000, but let's use this as an example. So of 100 grand.
Yeah. So if you go back, if you had a net operating loss of $100,000 in the year 2020, you're going to carry that back. You have the option to carry that back to 2015. And let's just say in 2015, you had that $200,000 profit. You're now only going to have in that year $100,000 of profit. And whatever tax you paid on that $100,000 of profit, let's just say for easy math, you're at the 24% tax bracket. You paid 24 grand in taxes on that $100,000. You're now going to get a refund of $24,000 that you paid taxes in back in 2015.
Okay, beautiful, man. So that's a really, really big one. And you've explained that really well. So now it makes sense, right? It makes sense. Now, what are some others that come to mind?
Another big one for the Tax Cuts and Jobs Act for a lot of CARES Act is the ability to take $100,000 out of your retirement account, like a 401k or an IRA, without getting hit with the 10% penalty. So generally, unless you qualify under an exemption, when you take money out of your retirement account early, you have to pay not only federal and state income tax, but you also have to pay an additional 10% penalty. If you were like laid off from your job, you were furloughed, you had hours reduced, your income was reduced, or you or your spouse or your dependents got sick with COVID and you had what's known as an adverse financial consequence, which the IRS doesn't really define what that means. But basically, if you fall under one of those categories, you're eligible to go into your retirement account, take up to $100,000 out and not have to pay that early withdrawal penalty. But that's not all. There's more.
Okay, there's more.
There's more like Billy Mays, right? So,
but wait, there's more.
There's more. Generally, when you take out that $100,000 out, right, you have to add it to income in that year you take it out. So it's almost like you got paid another $100,000.
Right.
You're now paying federal state tax on it. They allow you to now spread that out, essentially $33,000 and a third over 3 years. So now you don't have to pay the entire tax on $100,000 in 2020. You pay $33,000 this year, $33,000 next year, and $33,000 in 2022. And now you don't have to take that entire hit.
Sure. You can spread the pain out a little bit, right?
Exactly.
Awesome, man. Okay. So I'm going to pivot a little bit, Tom. So acquisitions, I think, a really good opportunity to start planning for how to take advantage of a lot of these different strategies and a lot of these different tax opportunities, right? So what are some of the common oversights that you see operators make when they acquire an asset as it relates to tax strategy and tax planning?
Yeah, I mean, I think one of the biggest things that I've seen for people who may be just starting out is not putting it in the right entity structure. We see some people use S corporation to buy their rental properties. And while there's nothing, particularly bad about it per se, it makes it very difficult if you ever go to take that property out of the S corporation. Yeah. You have to sell it.
It's not that you have to sell it. You just have to value it at fair market value when you transfer the asset.
Yeah.
I made that mistake, by the way. That's all I know.
The better way to put it is it can create a taxable event. That's probably the better way to put it. So you avoid that by putting that property in a single member LLC, or you avoid that by putting it in a partnership. Because there's a lot of flexibility you have with moving things out of a single member LLC that you own, or you have a lot of flexibility moving something out of a partnership. So entity structuring, putting in the right entity structure from the beginning is typically something that's going to help you out in the long run, because I've seen a lot of nightmares where we're trying to get something out of an S corporation or multiple properties out of an S corporation. And I've seen people pay a lot of money in excess taxes that they didn't need to if they just would have structured it the right way from the beginning.
Right. Now, talk a little bit about exchanging from, an S corp, right? So if you exchange out of an S corp, the property, so if you relinquish an asset out of an S corp and you're doing a 1031 exchange, the replacement property still has to be held inside of an S corp.
Yes. So the way it works is whenever you do a 1031 exchange, generally the same individual or entity that owns the relinquished property or the property you're selling has to be the same owner on title of the property that you're buying, the replacement property. So if you're selling a property of an S corporation, you now have to buy the new property in an S corporation. And unfortunately, that's when a lot of people find out that they shouldn't have put in the S corporation in the first place.
Right.
And now
That's
they're
why I
like,
bring that up. Yeah.
and now they're like, okay, how do I get it out of the S corporation? I don't want to have in this S corporation. And unfortunately, at that point, in many cases, you have no choice but to buy in the S corporation. So that's just another case. If you start off the right way, you're going to be in much better shape.
I had an experience, and this was a while ago, right? I was buying a bunch of property. It was literally a block in a really, really valuable area. Okay. Had it under contract, negotiated the deal, took literally months to put this deal together, right? From someone that owned a lot of real estate. I mean, tons of real estate, and took me forever to put this deal together. And so part of the value proposition was, she communicated that she wanted to get out of the restaurant business, and they owned a lot of real estate. And she was able to explain what she wanted to trade that money into. So I said, okay, well, I'll help you do that. Here's how we'll do it, right? I'll buy from you, help you trade into something that you want. Okay. And as long as I find you what you want, we have a deal, right? She said, yeah, we have a deal. And she was also part of that, did a seller carry. It was a sweet deal, right? And I'm not talking, man, like one or two properties. I'm talking like a block, okay, of properties in a place right now where that land would be worth literally probably about 10, maybe $15 million. Now, here's where things went wrong, okay? She held everything inside of a C Corp, okay? Yep. I'm going to speed this up. I'm not going to get to the details because there was a lot of consulting that was done along the process for me to try to make this work. The short of it was there was going to be a tax consequence to her. And, she's owned these properties for, you're talking 50 years, right? The family. She said, John, I simply cannot afford to sell. Everything's been fully depreciated, right? They had, basis was really, really low. She just said, I just can't afford to sell. Now, knowing what I know now, I could have done a lot, still could have put that deal together. I just would have approached it very differently. But that was one of my very expensive, what I call seminars. That was a very, very expensive seminar. And here's the irony behind that is there was a CPA involved helping to advise that, helping with the transaction on her end, that now the information being conveyed wasn't accurate at all, right? And so that was my very, very first realization that, John, it's your job to trust but verify. Just because that person has a bunch of acronyms behind their name, that doesn't mean that they understand how to exchange. So that experience, man, forced me literally to get really, really good at exchanging. And so anyways, that's a topic for another conversation. But to your point, I get it, man. I get it, because that cost me a big one. And guess whose fault it was at the end of the day? It was my own. It was mine. That was one of my very expensive lessons. It was mine, right? Because I should have picked up the phone and verified and called other people. Now I know exactly who to go to for that kind of stuff, and said, hey, look, I don't think this is right. How else can we approach this problem, right? And there are probably, at least now in hindsight, 3-4 other things we could have done. But anyways, to your point, I totally get it. I totally get it. In fact, more than I get it, I won't forget it.
Yeah. The bottom line is, I think for most investors, a majority of investors out there, I don't want to say never does a C corporation or an S corporation make sense for real estate. There are certain cases where that might make sense, but majority of people out there, single member LLC or partnership, that's how you want to own your real estate. That's going to give you the most flexibility. And by the way, if you ever do need to have it taxed as a C corporation or an S corporation, you can elect to have your partnership or your single member LLC taxed in such a way later on, but much more difficult to start that way,
right,
than it is to end up that way.
Yeah. I get it. And I really appreciate the comment. I'm going to talk to something else that I think is overlooked. So and I'm negotiating a deal right now. It's an office building. This is something that we're considering as well, right? That I'm actually proposing to the seller as part of a way that we put this deal together. So typically when we're purchasing an apartment building, okay, there's FF&E that's associated with a purchase that usually doesn't get broken out, right? It does not get segmented out. It's usually just included with the purchase. Well, normally what happens in an acquisition is, especially if it's a really, really large one, you have all this FF&E, okay, furniture, fixtures, In most cases with apartment buildings, it comes down to appliances, right? Refrigerator, stove.
Yep.
There may be some other appliances there, but a really big one is the HVAC, right? So you're buying an asset where those appliances, they have very little useful life to them. I mean, they're run down, in many cases don't work. Okay, now imagine you have a 100-unit apartment building. Okay, and on average, those appliances, when they're new, like say $3,000 per unit, right? Just throwing a number out there. Well, say that apartment building was owned for 20 years, maybe 15 years, and now you're buying it and those appliances have a useful life, man, of maybe 1/3 of that period, right? So say those appliances now are worth maybe $1,000. On the HVAC side, right, you have 100 units that have been repaired over the years, maybe a couple replaced here and there. So say you have 80 units that you intend on going in and replacing, right? And they still have some useful life to them, but not very much. Okay, so I think one of the big opportunities and one of the overlooked opportunities is expensing those assets. Because what ends up happening is we go in, we renovate an asset, and we just dispose of all of that crap, right? We get rid of it.
Yeah.
Not recognizing that there's a cost associated with that and that we can expense that today based on what some of that value looks like. And so, right, if you take, for example, and I'll let you comment on this, the example that we gave was, okay, appliances worth today, $1,000 instead of $3 times 100 units. The other side of that too is the HVAC. Okay, we have 100, right? Now there's some value there that still is inherent in that. So we're disposing of that business property.
Yep.
Okay, but we're not taking the expense. And in this case, it could be hundreds of thousands of dollars that we can expense directly that year, right? For disposing of that business equipment and not taking the expense associated with that.
Yeah, the partial asset dispositions.
Yes, sir. There you go.
One of the little known secrets of real estate. Most people don't talk about this.
It's not a secret anymore, man. We want to educate our audience. We want them to not make that mistake.
You explained it perfectly. Basically, what happens is when you acquire a property, everything that you acquire has a value to it. And you can usually get that value by either having it in the PSA agreement, if you negotiate that with the buyer or the seller, depending on which side of the transaction you're on, or you could do it through a cost segregation study. And the best example I can give of it, I mean, I know you did the appliances, which is a great example. Another example would be the roof, right? The roof has a certain value.
Right.
And if you know the value of that roof, so basically, let me take a step back. So that roof, when you buy the roof, it's being depreciated over 27.5 years for residential property. And then if you go and replace that roof, you're now adding the cost of that new roof, and that's going to be depreciated over 27.5 years, but you're still, in theory, depreciating the old roof. Partial asset disposition allows you to do is deduct the remaining cost, the remaining value of that old roof on the year that you dispose it.
Right.
So that can create a very nice expense for you on your basically tax return that can also help reduce your income. So that's a great point.
That's a huge one. And I know that's overlooked quite a bit. And it's just a huge, huge opportunity, but also one that can really enhance a deal, especially when you're trying to ramp up an asset, right? Making sure that you factor that in on the acquisition. And there are a couple different ways to value that stuff. And so anyways, I just wanted to bring that up because I think it can make a deal. It can make a purchase literally a deal if you factor that in properly and you don't forget it, right? You don't forget that. Yeah. So I appreciate you clarifying that. What are some other things, Tom? This is a great conversation because there are a lot of nuggets in here, man, that are applicable, right? It's like one thing to talk about things in theory. It's another to talk about things that you can actually literally apply tomorrow.
Okay, here's another little known secret that most people probably don't know about. And that's short-term rental properties, right? This is a gem. This is a true gem.
Bring the gems, man. Bring the gems.
For sure. So if you want to take the losses from your long-term rental properties against your non-passive income, so basically your W-2 income, for example, you need to qualify as a real estate professional, as we just discussed.
Right.
However, short-term rental properties, there's like a little caveat. If the short-term rental property has an average stay of 7 days or less, so you're either on VRBO or Airbnb, then it does not qualify as a rental property under the tax code. It's just a regular business. And because it's a regular business, you do not have to qualify as a real estate professional. All you have to do is prove that you materially participated in that business activity, which is a much lower threshold Like to give an example, if you own a short-term rental and you do everything on the property, then you're probably materially participating, and you could run a cost seg study or generate losses on that property and take it against your non-passive or W-2 income just like that without being a real estate professional.
Awesome, man. I really appreciate that. That's a great tip. Now, here's a question, okay? Who does a cost seg study on these smaller properties? Have you guys seen that in the open markets?
Yes, there's something called a software study out there or desktop cost segregation study that allows you to do cost segregation studies on much lower value properties. And that basically what allows people to do it. So I've seen a lot of people take advantage of those recently because before, without the software study, a traditional study, the lowest I've ever seen it, and a traditional study where an engineer actually flies down to your property for the most part, walks the property, breaks it down, costs probably around $1,500 to $2,000 on the low end, and that's on low end. Can go much higher than that. But the software studies, you're talking about a few $100, and you're plopping information into the software, and it's giving you an approximate. It's giving you about a similar result to what you get from the traditional study at a fraction of the cost. So that's what makes it studies on these smaller properties viable.
Man, that's a really good point. Very smart. And there's a lot of application there. So let's give an example, right? We have a $500,000 property that we purchase. Okay. 3,000 square feet.
Yeah.
All right. So now we do a desktop study on it. So in your experiences, now typically we can take that $500,000, we can divide that out. We can depreciate that straight line, 27 and a half years, right? Okay. So typically, 27 and a half years, let's see, what is that? 27 and a half, that's 2.5, 2.3. That's 2013.5.
It's about 18,000.
$18,000. No, for $500,000 divided by 27 and a half.
Yep, it comes out to be around 18,000. Say 500,000 divided by 27.5, $18,181.82 if you round up.
Okay, good. Perfect. So that would be straight line, right? So we straight line that, then we get a depreciation, non-cash expense of roughly around $18,000 a year. Okay, now let's say that we're using this desktop study. So in your experiences, okay, and now we have the ability to accelerate some of this depreciation forward. In your experiences, what does that come out to roughly? So if we have a $500,000 basis, typically we're getting about $18,000 today if we straight line. Does that come out to be about 50% of that basis that we can accelerate to date? Or is it 30%?
So my experience, it's somewhere between 15 to 30%. Depends on the property, the location, a number. It just depends on a bunch of variables. But the bottom line is, let's say you come in at the low end of 15%. You're getting a $75,000 deduction in that first year, thanks to 100% bonus depreciation. And that's sizable. And if you go to the high end, 30,000, you're talking about $150,000 deduction on a $500,000 property. Now, if you're at the 37% tax bracket, just to give like a scenario, you get a $75,000 deduction at 37% tax bracket, you're talking about a $27,750 tax savings. So you bought a property for $500,000 and you're now getting $27,750 back in reduced taxes.
Okay, so let me paint a slightly different perspective for our audience, okay? Everything that you said, man, I love it. I agree with it. Now, let's talk about folks that are limited partners out there. Okay, they're limited partners. They're passively investing in property. A lot of people, and the reason why I'm breaking all this down this way is a lot of people come to me and they say, John, I really love real estate. I understand the value in it long term because of inflation. Okay. And my very first partner, by the way, was my CPA. And this was about 12 years ago, right? So I work with a lot of CPAs. Don't ask me why. That's just how it went. So they come to me and they'll say, hey, I get the long-term advantage, right? Because of inflation and appreciation. But what I really want to understand is I hear people talking about the tax benefits and I'm trying to get my head around that. So we just gave a great example as to why this industry and real estate investing can be such an advantage, especially on the tax side of things, because, you know, it's great to generate income and to make money, but it's even more important to be able to save it because you're not having to pay out so much in tax.
Exactly.
Okay, beautiful, man. Beautiful. So with the scenario that you just described, which is great. So we had a $500,000 property. We gave a straight line scenario of roughly $18,000 that we can take that year. okay, over a 27 and a half period. We divide that by 27 and a half years, that base is of $500,000. The other side of that too, though, is if we decided to get a desktop study in that small property, okay, now this is of course hypothetical, depending on a lot of factors, but the point there being is we likely can accelerate the depreciation of that asset and get between 15 and 30% of that basis carried or expensed in today, right? Roughly speaking. Okay, beautiful, man. So that should be a really good conversation with many examples so that our listeners out there can grasp this. So before 2020, this is a great time to have this conversation, right? Okay, you have some time to implement all of these strategies or quite a few of them, okay, before you run out of time.
Oh, yeah. You still have to the end of the year to do some of this stuff. And for cost segregation studies, you generally don't have to do those until you file your tax return. So you have quite a bit of room to run with some of these strategies.
Oh, wait, say that last part again about the cost seg study.
Yeah, so the cost segregation study doesn't have to be done by the year end. It could be done after the year end. You just have to report the results of that study by the time you file your tax return.
Okay, cool. Awesome, man. Well, Tom, this has been a great conversation, man. Great conversation. I really appreciate you being on. I love how we walked through the conversation today, but more importantly, provided examples that have direct application to the things that we're doing today in our businesses, right? A lot of operators out there, a lot of passive investors. And so now I think you did a great job, man, of really helping people understand how this stuff actually works and why the benefit is so massive and how they can take advantage of it, right?
Absolutely.
Awesome, man. So I want to thank you. Hey, before I have you share your information with our audience, I always like to ask, what is the one question that you have of me that you feel can add some value to our audience?
That's a good one. A question for you. This is tough. Who is your audience? Who is the target audience?
Yeah, no, I really appreciate that. So we have roughly about, I want to say about 40% men are operators. Another 40% are passive investors that have experience investing in real estate projects, right? You're passive. Mm-hmm. And then the balance of that would be folks looking to get into this space, whether it be operators, investors. We don't really know that yet. Hard to figure that out, but we're trying. But that's what our audience looks like.
All right. Two things I'll say on that. So for everybody who's in there, the owner operators out there, what we just discussed today is super powerful for you, something you definitely take advantage of for the passive investors. Just know that, you're not going to get these huge necessarily tax benefits all at front, but you will eventually achieve those over time. That's kind of how I would angle that, but I'm not sure if that's what you were looking for.
Yeah, no, I really appreciate it. Yeah, no, there's no right answer, man. It's really designed so that you can share what comes to mind based on those questions. But the idea is to provide feedback that we think our audience could benefit from. So you did a great job of that, Tom. How do people get in touch with you? The real estate CPA.
Yeah, so there's kind of a handful of ways you get in touch with me. The first one is LinkedIn and Facebook. Just type in Thomas Castelli, you'll be able to find me on there. And also we have a podcast, the Real Estate CPA podcast, out now on all places you find a podcast, you'll find it there. Where we talk a lot about tax strategies. We go in depth in the stuff we discussed here today on today's podcast, as well as a number of other strategies that you may not hear about anywhere else. So that's always nice. Otherwise, outside of those, the realestatecpa.com would be the best way.
Awesome, man. Hey, well, you've been great to have on the show. Thank you so much for your time and your wisdom. And I want to wish you continued success.
Likewise. Thank you for having me on today.
Thanks, Tom. Clarity of purpose creates our greatest competitive advantage. When we transform apartment buildings to thriving communities, we improve how people live and create assets with high profit margins. Don't forget to subscribe, like, and share this up with a friend. I'm John Brackett, bringing you things you can implement right away.